A big hello and a very warm welcome to HSBC Mutual Fund presents Informed Investing Season 2 partnered by ET Now. I am Kavita Thapliyal. Today we are diving into a powerful shift in how businesses manage idle profits, moving from fixed deposits and current accounts to smarter, more efficient options like mutual funds. We'll explore how liquid and debt funds provide easy access with better returns, how SIPs and STPs can turn irregular income into long-term wealth, and why tax efficiency and diversification make mutual funds a compelling choice. Plus, a key insight: always keep business investments separate from family finances. With that, our theme for today's special episode is relevant to enterprises everywhere, from business profits to portfolio growth. We will explore mutual funds for business owners. Joining us today are Kailash Kulkarni, CEO, HSBC Mutual Fund; Paresh Sukhtankar, Head of Distribution at Reliable Investments; Bharat Bagla, CEO, Bees Network; we are Ayappan, Director, EVA, Mera Funds Investment. So let's dive right in. Let's talk about the trend first, and I want to begin with you, Kailash, because AMFI data shows that the money that's been parked in debt instruments, as far as mutual funds are concerned, the number is going by what, 14% CAGR every year. I want to understand what kind of instruments are we talking about, and traditionally what we've seen is when it comes to having a backup, if you own your own business, usually people mix their personal finances with their business finances, okay? And even if they have to consider diversifying, what they usually prefer is maybe gold, fixed deposit, a lot actually, and a bit of real estate. But looking at the trend and looking at the AMFI numbers, how is it changing and what exactly is changing?
So the good news is that the awareness about fixed income or debt mutual funds is growing significantly. Earlier, it used to be like mutual funds is equal to equity is equal to something. But today, I think a lot of small businesses, MSMEs, are also participating in treasury management, so to say. So while you always knew that the large companies have a separate focus on treasury management and they utilize the surpluses in a way that they could get a lot more fee income and enhance their profits, I think the smaller companies never did that. Today, two things are happening. One, control on costs and how to efficiently manage your money. I think the businessmen and the MSME promoters have started to realize that and started to invest in maybe liquid funds or maybe 1 to 3 year kind of short-term bond funds. And that's something which we are seeing in a very compulsive manner, that people are wanting to know about it and asking the questions, which are not so relevant maybe 3 years ago. I'm not even talking 10 years ago, just 3 years ago. So that's a big change in terms of habits that we are seeing in the industry today.
But Mr. Ayappan, if I were to talk about the red flags and the kind of mindset which is changing, but we are still not there yet. If someone wants to compare maybe liquid funds, if we have to just continue the conversation and take a line from there, when they want to compare it, what are the challenges? And in terms of return, because that is a very crucial aspect. I want to know how much am I earning over that money, because these are my profits. It's my idle money that's growing already, which is there in a fixed deposit. It's safe, it's secure. I have my peace of mind, okay? But over here, we're talking about debt funds, which are comparatively new. Yes, there is an edge. There is tax efficiency also. But when you compare it with the fixed deposit, what is the biggest plus point?
See, today taxation difference is not much between a fixed deposit or a bond fund.
Post the indexation going.
Yeah, post the indexation going. Yeah. But what is the big difference you get is like flexibility. In an FD, you need to plan it in such a way that in a staggered manner, how much you want, you need to withdraw. If you want to even remove partial money, you need to exit the full FD. Whereas in a bond fund, you can exit whatever partial amount you want. Flexibility is one thing. And second thing is, obviously you are postponing the taxes to the future years, right? Because even whenever you are exiting, until that you are postponing the taxes. Whereas in an FD, accrued interest, it is taxed based on your accrued interest. So for a given financial year, whatever interest is accumulated, you end up paying taxes during the same year in an FD. Whereas in bond, you keep postponing that for a longer period. And generally, you can earn 0.5 to 1% excess return if you play a little bit duration better, depending on the interest rate cycle, right? You can take a call on long term or a short term depending on the nature of the interest rate movement. So the treasury management tries to do that. So bigger companies are good at it. Smaller companies, you don't have that kind of skill set. But if they use it properly, they can play that half 1% excess return. That is one more advantage which you get it. Okay. So that's the main advantage I feel.
But when we talk about businesses, okay, we're talking about business of separate sectors and different nature of businesses where the money flow is very different, your requirement is very different, you definitely need to have a lot of contingency also parked in. How can debt as a category, because 16 options of investment we're talking about in a debt category, okay, depending on every duration you can put money, you can park in money. How can you play with it as per the nature of your business?
See, so many businesses have a lot of balance lying in current accounts on which they don't get anything.
Right.
So for example, a big corporate with big amount of money lying in current account can also park it on a Friday in an overnight fund and remove it on Monday.
Okay.
Because that's a huge sum for 3 days parking in a overnight fund. Then after overnight fund, there are liquid funds. So the funds which you don't need for 1 month, 2 months or 3 months, you can park in liquid funds. There is something called arbitrage fund also, which is categorized as equity fund. And there the taxes are still lesser than the proper debt fund. It is only 20% for short term and 12.5% for more than 1 year.
Okay.
But most of the businesses have also started looking at conservative asset allocation funds.
Okay.
If they don't foresee any capital allocation requirement for next 1 or 2 years or 3 years,
okay.
If they don't require for 3 years, they are shifting even to equity funds and hybrid aggressive funds.
Okay. For 1 to 2 years time horizon, won't that be risky?
More than 2 years.
More than 2 years, definitely.
3 years plus.
Yeah.
Because businesses themselves are risk takers. So they don't mind putting that money to use in a better way.
Right.
Because putting a lot of money into liquid funds causes their return on equities to compress.
Okay.
It reflects badly on the balance sheet. If there is too much money parked in liquid funds, which is earning only 6-7%, their ROEs get depressed.
Okay. So one needs to diversify.
So there are so many issues. Every issue has to be considered. Each corporate is different. Their business is different.
That is what.
Their cash requirements are different.
Right.
So accordingly, we have to manage their treasury.
So how can you strategize it depending on the kind of options we are talking about? And he also spoke about, strategies where you can go long and short and depending on the capital requirement that you have. How can you strategize it, diversify it within the investment options that we are discussing?
So typically, when you look at an investment entity, a business owner, whether he's an MSME or an SME or a large corporate, like Kailash said, that large corporates have their own treasury teams.
Exactly.
Who are trained enough to handle the cash flows better. But if we are to move aside and look at the MSME and the SME segment where they do not have a finance department per se, and most of the decisions are driven by the promoter or the entrepreneur himself. So he's looking after all the aspects of business. So it's important to get into a planning kind of a strategy where you have someone help you do this. That's the step one. Okay. You can't really do everything. So have somebody to advise you on that and let that professional figure out whether you have a current account surplus. Maybe a SME is already operating through an overdraft account. Then using that overdraft money and investing in a liquid fund becomes a counterproductive.
Okay.
So might as well leave money in the bank account and reduce your tax outflow, interest outflow.
Okay.
If the MSME is operating out of a current account, then you can start allocating that money to, like he said, overnight funds, liquid funds, etc. across the spectrum. Do it for a particular period of time, maybe a couple of months, and see how the cash flows behave. Like for example, we did this one for a particular client and we ran this exercise that every time there was a surplus in the current account, we just kept parking it in the money market fund.
Right.
And after a year, we realized that in spite of the whole year, there was a certain amount that they never withdrew from the money market account.
Oh.
So now, after a year's time, they had this idea that, okay, now this is that money that can be looked at for better allocation.
Okay.
So then we could move some part of that outside the money market to maybe, like he said, the short-term fund or the medium-term fund and get them a higher return.
Higher return. Why not? Yeah, definitely.
Across the spectrum, 16 categories, right from overnight to liquid to money market to ultra short-term to low duration to short-term to medium-term. There are so many. So it's important for somebody to have a professional help them and identify for what durations can we put what money.
What money?
And then utilize them efficiently.
I just want to add on to that, it's very interesting. In India, thanks to the holidays that we have, various kinds of festivals across communities, you easily get anything from 7 to 10 long weekends. Okay? And this money lies in the current account where you earn zero, right? That's where the conversation moves. And initially, what we have seen, these smaller companies tend to say, okay, let me try it out. Let me put 10 lakhs. And then when I put in the redemption, they see, oh, it hits my bank account by 9:30 a.m. in the morning. Then they start saying, okay, it's damn good. I don't have to go anywhere. I don't have to send a runner boy. It's all done online. And that builds their confidence. So they start small, like Bharat was saying, and then it starts to build up. And then they realize, oh, what is happening is it's actually taking care of my 1 month of electricity expense. I'm now able to pay from just using the money smartly. So they start typically with the long weekends, like was suggested. We have so many weekends, Friday, Monday, but it could be Thursday, Monday, and then go on from there onward.
Right.
And that's how more and more people have tested it out with small amounts and then saying, okay, we can do much better management of the money which is there.
All right. So, but then what's the taxation ideally on all of these investments?
This is same as income.
Okay.
So it will get added to your normal income and will be taxed based on your tax slab.
Whether it is for 2 days or 2 months?
Yes.
Okay, so that is tax efficiency, a very big plus over here that we're talking
No, it is
Unless
similar
it's
to
arbitrage fund.
Okay.
Then the tax is much lesser.
Okay. You were saying something.
People are not looking at it from a tax perspective
Yeah,
because they are looking at it from earning zero in a current account
exactly.
to something more. So anything more than zero is a positive,
Obviously.
right? You don't mind looking
Right.
at it. So that's how people are starting to look at it. And that's why you see more clients coming into this part of the business today.
Sure.
Today, while you want to grow top line, you also want to be more efficient on costs
Right,
to make
right.
your profitability better. I think that is how people are looking at these kind of products.
With that, we'll take a short break. But this special episode of HSBC Mutual Fund presents Informed Investing Season 2 partnered by ET Now continues on the other side. We'll be right back. Welcome back to HSBC Mutual Fund presents Informed Investing Season 2 partnered by ET Now. One very important aspect, not to mix up your personal finances with your business finances. How can you do that?
See, there are two aspects which are currently happening, especially in private companies which are closely held.
Okay.
So the tax rate on private corporates is now 25%. So they take out only basic salary, which is taxed in their hands, and let the surpluses remain in the company itself
Okay.
to be invested into mutual funds or equity or debt funds or whatever as per their requirement.
Okay.
There again, power of compounding happens without any tax till you don't sell it. Plus, the tax is withheld even for personal tax is also saved
Okay.
by not withdrawing.
By not withdrawing.
But it is true only for closely held companies in private limited. So they are having a huge tax arbitrage. Otherwise, they were paying 37.5%. Now taking less salary and investing in the company itself, they are paying only 25% tax. Secondly, there is a new trend of going asset light in businesses. They don't invest in real estate. They don't buy offices. They rent offices. So a lot of surpluses remain in the company itself, which can be again go into financial instruments like mutual funds. Though that is catching up fast.
Can you elaborate more on the asset-like concept? And I think you're talking about the new age investment style, which people are also opting for. A lot of millennials who are getting in the startup culture, and like you also mentioned, no real estate and no heavy head-ons on their balance sheet. How can one go about that and have a very asset-like structure in the
Yeah, so for example, what he mentioned, that more and more businesses are saving capital by not having to invest in their own offices.
Okay.
So if a
So no
new-
real estate, no
Yeah.
traditional investments basically, no fixed deposits also,
Maybe some.
Maybe some.
But
Okay.
if you want to expand, let's say for a business wants to go into 10 cities. Now, You go to 10 cities, you buy 10 offices, put in the infrastructure, the furniture, get people, get the necessity permissions, etc. A lot of time, a lot of money. While now we have places like WeWork and all these rental solutions where you can start offices on day one. And you don't need to put in that capital to buy that office. So like he mentioned, you save that capital and you become asset light, you become functional on day one. If you find that A market is efficient for you, is good for you, is profitable for you, you subsequently expand.
Okay.
If you find the B market is not doing well for you, you close down and move to the other market.
Okay.
And without having a dent on your capital.
Capital, exactly. So this is really catching up, and how is the global trend on this then?
So globally, of course, it's a much more advanced stage. So
Exactly,
the people used to this.
Yeah.
Here we are still learning, we are still exploring, and just trying to take in a point, where you see that you have invested for the full year, and you realize that 20% of the corpus you never touched for a year. That's when the next stage of the conversation starts. That why don't you move this from a very 3 to 6 month kind of a product to a 1 to 2 year product. I think that's stage 2. So we are moving from a direction where you were absolutely not doing anything to now doing something with your money and then trying to make it more efficient. I'll give you one more example, a real life example. We went to one of these companies, and what they did is very simple. Earlier, the vendor bills that they had to pay, they used to pay every day. So when the bills used to come, they had a cycle and they used to pay. They said, no, we'll only pay vendor bills on Wednesday.
Okay.
Okay. So whenever the bill comes, at that particular, suppose it's a 30-day period that they are giving the vendor, 30-day, they'll pay it on a particular 30th day. They say, no, only on Wednesday. So all the incremental daily income that was happening to the company, because they sold their goods, they got their cash, they would start parking in overnight funds or liquid funds. Yeah. And then they will withdraw on Tuesday. So the money will get credited to the bank on Wednesday morning. Yeah. And Wednesday is when they do the payout. So just imagine, they suddenly, just by making small tweaks to their payment cycle, they could use their money efficiently to make some more money.
Exactly.
I think that's how people have started to look at this.
But don't you think it'll be difficult for this entire phenomena trying to catch up in tier 2 and tier 3? I mean, it's very much a very urban concept, is it right?
Actually, no. There are people in tier 2 and tier 3 who have started to experiment.
Really?
Because they talk to tier 1 and then this is the kind of messages which go, oh, have you tried this product? See, there's a lot of word of mouth comfort which you get from other businessmen that you deal with, right?
Yeah.
And if you come to know that my friend who's say in Pune or a Bombay, which is so-called more progressive markets in the financial services world, if they are doing this, why aren't I doing this? Maybe I was not aware of it, or nobody came and told it to us. So that's how they start to, but you see this across the length and breadth of the country. It's like I said, it's in infancy, but can I see this catch up significantly? The answer is yes.
Now, since we're talking about businesses, I don't know how much of a concept of an SIP or STP or SWP can be aligned with this. Is it possible? Because for retail investors, usually we talk about SIP being the best route to invest in mutual funds. If you have lump sum, maybe you can try an STP. But then what about businesses?
Yeah, so whenever businesses also, they have to plan for their short term as well as long term needs.
Absolutely.
Right? So whatever we are looking from a short term perspective, we are speaking about liquid funds or bond funds, all those things. But many a time business wants to build capital for expansion. So every 3 years, 5 years, they want to go for a next level of growth. They want to set up, invest in infrastructure. They want to hire a team. They want to spend on technology, which requires a huge capital. So how will you park or build your capital? So that can be done through SIP on equity funds, which you can plan for over 4 years, 5 years, and then you get one lump sum which can be used and fund it. So generally businesses, whenever you have retention, right, whatever after profit you are retaining, that retention, every business owner wants to reinvest back as early as possible to the business because they love their business. But so many times it so happens, investing could make more sense than reinvesting back in business. Right? So now let's assume a mutual fund, generally you get 13-14% return over longer period. Right? As a business owner, if I don't make 18%, it doesn't make sense. right? Because I'm putting not only capital, I'm putting my time as well as entrepreneur skills and taking stress. So I have to at least make 3-4% excess return to justify the effort I'm putting.
Exactly.
So if I'm still making 14%, better I play a passive game, give it to a fund manager and sit quiet. So many times what happens, any businesses, right, it goes up to a particular economies of scale. After that, diseconomies of scale will come back because they may not keep the process in place. They may not have people in place to take care, right? So the business owner should understand where is the gray line, where I should stop reinvesting back in the business. Instead of that, play a passive role and build the capital, which will be more efficient way of building the, making the asset use. Right. So for example, if I want to give an idea, so currently some company invests $100 and they're making 16%, 17% ROE. Now they go and incrementally invest $20, but the return on equity from 16 will come to 15. Okay. But if you see the incremental average of the $20, the return on equity will be only 8-9%. That's why your overall ROE has come down from 16 to 15. It is not on 100, it is on 120. Right? So the new 20 will generate only 7-8% return. So you would have been better off investing at 14% rather than reinvesting back in the business. So somewhere when the ROE started dipping, so that's the time the entrepreneur or business owner should realize it is not going in the right way. So they should not always see the overall ROE of a business. So they should always look at the incremental ROE for every capital they are deploying back in the business. So in those cases, equity or SIPs will come into a play, whichever you feel that excess money which is being circulated in the business, at least which you feel long term, you keep pushing into a SIP of equity funds.
And SIPs are more suitable when there are predictable cash flows to the business. There are some businesses where there are lumpy cash flows. In some businesses, there is a regular cash flow. For them, SIP is suitable. Secondly, the promoters become very greedy when they are doing well in the business and they tend to overinvest. That's where our role comes in to tell them that you have to keep something out if something goes
with
wrong.
With an example, if you can explain the scenario of overinvesting.
Exact GFC during global financial crisis, all the top builders I know, they were stuck like crazy. Means they had overinvested. Many of them died the natural death, as well as their companies also died because they overinvested. They were doing so well in that cycle from 2003 to 8. The real estate prices went up 5 times. So everybody became greedy. They went and overbought things with leverage. And when the things got bad, all of them were either wiped off or they took 10-15 years more to come back to.
Oh my God.
So we have to educate them to diversify a little away from their business so that in such cases they are not caught on the wrong foot.
If I can add,
Sure.
Like you mentioned, how can businesses use SIP to better plan their finances? Even businesses need to plan for their employee retiring, gratuity planning. Okay, the use cases can be endless. So what's more important is to keep moving some portion of your cash flow to a bucket which is to be used on a rainy day. So if depending on the business size, whatever amount is permitted, and it's okay even if business is lumpy, if a certain month your SIP does not go through, but for those months when it has gone through, you've been able to move aside.
True.
So the use cases can be a lot of them.
Right. So taking a leaf from this conversation, if someone is watching this show, listening to all of you guys, has a business to run, how according to you should they be doing their homework and planning out their finances to be invested? In what order?
So see, inherent, all businessmen are very smart. They know how to manage their business very well. The challenge is managing a business and managing money are actually two completely different things in life. Okay? I may be an expert in a particular technology, and because of that technology, I'm manufacturing a particular product which does very well. I'm a superb guy at that. But do I use my money well to enhance my overall company profits? Generally, the answer is no. It's very well prevalent in only the large corporates. Okay? And this is something people have started to realize that money can make you money or money can lose you money. So how can I get my own money to make it better for me?
Yeah.
So one of the things I love to say is you don't need money to make investments. Whatever you have, if you use that same money to invest it in a manner where you get a little more than what you are getting with the similar kind of risk, you've actually done investment. I think that idea is now germinating in people, and they are willing to consider this. And let's be honest, in the last 10 years, how many times have we had a panel discussion on fixed income, treasury related things, right?
Right.
Zero.
Right.
Just these conversations are because today we are seeing this happen.
Right.
And I think that's the beauty about this product.
All right. I think with that, it's a wrap on the show. But thank you so much for being with us today. And yes, way to go for all the Indian businesses. You've got to have your investment strategies right. And yes, because you have so many investment avenues just under mutual funds, make the most of it to decide the future of your personal finances as well as of your businesses. Thank you so much for watching. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.